We are so honored to be here today to bring you another wonderful program for Tuck Alumni Lifelong Learning. Today's topic is on energy transitions, innovation, investment, and impact, and we are joined by four esteemed panelists that we are so excited to introduce you to. A little housekeeping. My name is Heather Law, and I am the Director of Alumni Career Services. And this program is brought to you by Alumni Engagement and the Rever Center for Energy, Sustainability, and Innovation that is led by Jonathan Silverthorne, who is on your screen. And we are so grateful for this partnership. Just to get a little bit of a sense as to who is with us today, we'd love for you to put in the chat where you are hailing from and what year you graduated from Tuck, so we can just get a little bit of a sense as to who's in the audience. And please share that with everybody. It's always fun to see where everybody is at. So while you're putting those things in the chat, please know that this is being recorded and can be found in a few days on our My Tuck archive. And so that way, all of the wonderful information that's going to be shared, you will be able to have. And then just a little bit of a plug, if you enjoyed this program, tomorrow from 4 to 5 p.m. Eastern, we're doing a Tuck networking together that is on the energy topic. So if this is a topic that excites you, it's a great time to network with alums from across the globe for an hour in breakout groups. And you can talk all about this program and some of the really interesting topics that have been shared. So I'm so happy to see some people from all over. We have London, we have Boulder, T’15, T’94, T’95, Minneapolis. Fantastic. Everyone from all over the world, which is one of the many things that I love about Tuck. So with that, I'm so honored to be joined here by our wonderful moderator, Emily Bergan, who is a T’22 and is currently an associate at McKinsey and working in the energy field. And so, Emily, I'd love to turn it over to you. Thank you for leading this panel today.
Yes, absolutely. Thanks, Heather. As she said, I'm Emily. I'm a T’22 based out of Denver, currently working at McKinsey as an associate, doing most of my work in energy. We have some great panelists with us today, so I want to pass it off to them to do a quick intro before we get into the discussion. So, Jon, do you want to start us off with an introduction of yourself?
Sure, happy to. Jon Fouts, Tuck 92. Doesn't sound like there's many Tuck 92s on the call, but Tuck 92 have been at Morgan Stanley for 30 plus years, and I had the power, utilities, renewables, and clean tech business from a banking perspective here at Morgan Stanley.
All right. Thad, do you want to go next?
Sure, thanks, Emily. Thad Hill, Tuck 95. After Tuck, I was with BCG for 10 years, and then I moved into industry. And at Calpine, I'm currently the executive chair, but until October, for almost 11 years, I've been the CEO here at Calpine. And we're a large, I just mentioned, we're a large, the largest natural gas-fired generator in the country, among other things that we do.
Awesome. Thanks, Thad. Caroline, how about you?
Awesome. Thanks, Emily. I'm Caroline Mann. I'm a T’15, live in Jacksonville, Florida. I'm the Vice President of Origination at Swift Current Energy. Swift Current's a developer, owner, operator of wind, solar, battery storage projects across North America. And I, in particular, oversee our revenue structuring. So revenue strategy, revenue sales, all of our revenue structuring for the company. Happy to be here.
Thank you. Well, kicking it off with a big picture question for us, and this is for whoever wants to jump in first. The energy transition is one of the defining industrial transformations of our time, touching everything from how we produce and store power to how we invest in and value energy. From your vantage point, what's the single biggest shift you're seeing right now that signals this transition is accelerating, or is it stalling?
I'll go first while we're waiting. Look, I actually think that the bigger trend is not the transition, but rather electrification, which is, and you can have debates about where we go with this, but about how electric load is growing dramatically, and people view it as a way to decarbonize. There are also all kinds of other reasons why electrification is being pushed. And it is an enormous trend and one that, and I'll just stop here for now. There are a lot of challenges that we'll all have to work on. So, yes, decarbonization is a part of it, but electrification is bigger than decarbonization, although it certainly includes it.
Yeah,
Yeah.
I would just add to what Thad said. I would actually take it a little bit further and at least from a capital markets perspective, one of the things that we've seen is you go back 2 years ago, it was all renewables, clean tech. And I would argue that over the past 24 months, largely as a result of some of the demand trends that Thad's referencing associated with artificial intelligence, data centers, hyperscalers, we can't meet that demand without conventional generation. So we've seen a big shift back towards things like not coal, but gas, nuclear, and things like that. And it's being reflected in the capital markets, which we couldn't have talked about 24 months ago, maybe even 18 months ago. So that's a big, big shift.
I fully agree with both of those comments, even from my vantage point as a renewable developer. I mean, just the demand that you're seeing via AI and, and I think with renewables, you see, I mean, there is a lot of federal policy uncertainty right now, and that's not new to the renewable ministry at all. I mean, you've seen that over the last 30 years a lot in the tax credits, and you see oftentimes with that boom bust cycle on the federal side, you see this demand come in and sort of buoy the demand for renewables. But, I think you see all that in the corporates. A few years ago, these corporations that demanded renewable energy, they were buying power, renewable energy credits. But then I think now you see this AI demand and even renewables alone, there's no way that renewables could meet that fully. So I fully agree with exactly what Thad and Jon already said. I think that's the biggest thing right now is the AI demand that's coming.
And Emily, if I could, just to maybe, saying it's true, but 3 or 4 years ago, we had policy objectives in this company that were incompatible with physics. And I think if there is anything that has occurred in the last several years, it has been that, physics are back. They're pretty unyielding things, and I believe that people now recognize you got to serve physics first, and that is, I think, created a brand new change the dialogue dramatically.
Absolutely. Yeah, I think that makes a lot of sense. And what I hear from all of you is we have to have a very broad view of what we're looking at for energy and a very all-encompassing view. Is there anything within that you think is the most transformative technology that we're looking at? And what are we missing to meet this massive growth in energy demand?
And this is a reliability, not a point, not a transition point. But I think it's true. What I believe is most underutilized right now is price responsive demand. And we're beginning to see that initially in Texas, which is leading the country. And we're all over the country, New England, California, the East Coast. And so we're in all of these major markets. The market here in Texas is a little more unique because prices can be higher and more volatile, and thus create a lot more incentives for people to figure out how, if you're an industry, if you're worried about freezing in your home, you're probably not responsive. If you're running a business, there's an opportunity to make more money by either coming off the grid and using backup gen, or even by sending people home and shutting down the process for a really cold weekend. You're doing it. And I think in Texas today, we've got 10,000 megawatts of price responsive load, and I think there's a lot more to come. And Duke University just did a study, and I'm going to mess up the specifics of this, but they actually said something like, look, if you're willing to curtail 40 hours a year, you can handle all kinds of new AI load in the country because we're building out the grid for those last 50 hours a year. And so I think, to the degree we can get price responsive load deployed in these markets in a commercially savvy way, it changes this reliability dynamic in a real way. And I think we're just right at the beginning of that.
Absolutely.
I believe we still, and that I agree with you on that. I think as one of our particular pain points as a developer, owner, operator is transmission, right? I still think we do not have enough transmission in this country. And then the processes for bringing generators online, the lengthy studies that you go through to interconnect, as well as just, you see with, one thing that's, I think, really developed a lot over the past few years that, if you think about batteries, to me, like 10 years ago, batteries were kind of a science project. Now there's a supply chain around them. You have traditional utilities procuring power and operating batteries. You've got capital markets that are investing in batteries. That's really come along and sort of smoothed out of your time of day volatility in power markets, but you still have a lot of locational volatility around, the supply not being near the demand, and the power markets, still haven't really been able to correct without, I think transmission is really the missing link. And so better processes, better kind of investment, permitting processes, for example, around transmission, to me, that's one of the critical things still needed.
Great. Jon, anything you want to add there?
I maybe we'll come on to it a little bit later. I think, all the technology is here, whether it's the gas turbines or the solar panels or the turbines for the wind and the batteries and things like that. I mean, we can obviously make some marginal improvements and all that, and that's been happening. There's a lot of talk about what happens to nuclear, and in particular small modular reactors or SMRs. And I know people get really excited about that. And maybe this is a whole nother topic, but our view is on SMRs that we're probably at least 10 years away from having actionable, reliable, cost-effective SMRs that can help balance the grid and the load. And I know that a lot of people are enamored with that, and you see a lot of announcements by some of the big hyperscalers about investing billions of dollars into the SMRs. And I know that will be somewhat controversial, but I think that's a little bit of optics or eye candy, because I think we're probably 10 years away from actually having SMRs that are really functioning and economic.
And if I can, I agree with Jon on the SMRs. They're wonderful, but there's no, and by the way, it's probably all in our best interest. The government helped get the first couple of these done, but there's no commercial framework that can pay for these things, even dramatically, because people and their light bills aren't going to pay it. So and just in category, maybe saying something else that is not going to play a real role is hydrogen. So let me be controversial there, because that was actually, out there. And just to illustrate my point about hydrogen with a little fun math, if you have a 500 megawatt power plant, which depends on where you are, but New England is probably enough for 500,000 homes of electricity generation. To run that 500 megawatt power plant 50% of the time on hydrogen, you actually need to make green hydrogen from water, right, for hydrolysis. You actually need, besides the water and a whole bunch of storage, you need 4,000 megawatts of solar panels, which takes up 24,000 acres of land. In order to get enough hydrogen to run a 500 megawatt power plant that sits on 10 acres. The energy density here is just incredible. And while hydrogen will have some industrial applications, there's some growing industrial applications that will not make a meaningful point at all in the electric sector. And unlike nuclear, which I think there is someday, I have a really hard time of coming up where it might even play a role someday, given the energy density and the economics of it. So hopefully that's a little controversial if Jon is. I'll try and up him one.
No, I think that gets into exactly what my next question was. Are we at risk of over prioritizing breakthrough technologies and underestimating the importance of deploying what we already have at scale? And I think we're starting to answer that. But do you think that the way we're handling these new technologies is appropriate? Is there too much emphasis on them, or do we need to be focused more on scaling what we already have?
Scaling what we already have. I think Caroline hit it. I mean, it's things like policy. It's things like regulatory dynamics in the ISOs that is referencing. It's the grid. It's updating the grid and making the grid more reliable. Like I was saying, we have the technologies to do that. We just got to get coordinated from a regulatory and a policy perspective to make this stuff happen.
Yeah, I fully agree. And I think, the market's efficient, right? And I think the market will say, right, because I completely agree with both Jon and Thad on hydrogen and new nuclear, small SMRs. Like, I don't think they're cost effective. I don't think they're competitive. Now, if you look at there's some new nuclear plants that are being restarted, and there's demand If you look at 3 Mile Island, there's kind of a handful of nuclear plants that have been recently shuttered that are being restarted. And there's contracts in place that are supporting those economics. So there's demand and it's competitive. But I don't think you're seeing that on some of the hydrogen and kind of SMRs. They're just a little bit too far off.
Yeah. And Emily, look, I have no trouble with some government support for nascent technologies. That is absolutely an appropriate thing, with some of these. It's just, but we also have to keep our eye on the ball. As both Caroline and Jon said, the grid's got to work.
Absolutely. Makes a lot of sense. All right, Jon, I have a targeted question for you. How are capital markets adapting to the energy transition? Are investors getting more comfortable with risk in new technologies or business models?
Is that before the last 2 weeks or after the last 2 weeks? I would argue that, the capital markets are embracing the new technologies broadly. There's plenty of capital that wants to flow into this sector. I joke with my team, it's kind of nice to be the cool kids on the block now with, all the developments, particularly the transactions that we're doing that are being driven by AI. But the business models do ebb and flow. And if you go back and look past couple of years, the whole yield co model and MLP model has sort of morphed into a new version of that. I'll come on to that in a second. That was probably more, cash flow driven and fundamental driven. Then you had a period of time where SPACs were a big thing. Those have fallen by the wayside. And so what I would argue where we are in the life cycle of the markets right now is there's plenty of capital looking to come into this space, probably unlimited capital. And it takes many forms. It takes public capital, regular way equity and debt. It's taking private equity capital, which we spend probably at least a third, maybe half of our time talking to private equity sponsors about investing in the space. Importantly, a subsector of that is private credit. A lot of the insurance companies and pension funds are funneling money through the private equity firms into this space. And so there's no shortage of capital. What I would argue is happening in the past couple of months from a business model perspective that's attracting capital. It's morphed from very bespoke, smaller companies to larger companies, critical mass, having access to the capital markets, which is really being driven by, I guess what I would say, having companies having fully financed business plans. What do I mean by that? It means that as an investor, I'm not going to put money into a company if I can't see my way to them being in a position to generate cash flow to develop their CapEx or to fund their CapEx. In other words, there's not multiple rounds, or it's very difficult to finance companies that require multiple rounds of financing to make cash flow positive. In a more ebullient, bullish market, maybe we shift back to not necessarily needing fully financed business plans, but that's what we're looking at right now. So many of the models have morphed from these development companies and what I would call VC companies into integrated companies that are doing a combination of development, R&D, and so forth. But they also have operating assets that can generate cash flow to help finance that development and R&D. So, Caroline and Thad may have different views, but that's what we're looking at today from a capital markets perspective.
Caroline, Thad, anything to add there?
Oh, I agree with you, Jon. It's a great summary.
Awesome. All right. Caroline, for you, hyperscalers are now major energy buyers and infrastructure players. How are their demands reshaping how projects are developed, financed, and prioritized?
That's a great question and certainly a hot topic. You look at the forecasts of demand coming from this AI, the data centers, whether they're AI or crypto. There's tons of these data centers being developed all over the grid. And then the power demand outpaces, what's forecasted even to come online many times over. And particularly when you look at a renewable project, any sort of data center that connects there is going to outpace what a renewable energy project can generate many times over. So, I think it's interesting. I think the grid's really still trying to adjust for this. I think for us in particular, as a renewable energy developer, we're seeing tremendous demand on a lot of our projects, and we're sort of really actively trying to develop a number of our projects such that a data center could interconnect kind of alongside us. It's not every site's a great fit there. You've got you need to be close to a workforce, fiber, water needs. I mean, there's a whole host of things that make a data center a great site that don't necessarily align to what makes a great site for a generation project. But I think for us, what we're seeing most is this demand for speed to market from data centers, where you've got generation assets that have infrastructure, transformers, high voltage equipment already in place. And if a data center can, instead of having those long lead times for that infrastructure, come in and kind of plug in alongside you, there's a lot of demand for that. So whether or not the demand for the specific renewable power is sort of all over the map. You have some kind of these hyperscalers that have these green goals. They want to buy power from your solar project. You have some that really just don't care, honestly, and they'd rather have kind of a very predictable supply of power. They're going to connect directly to the grid. So that's a little bit all over the map. But I think what we're seeing a lot of interest in this kind of speed to market play. The other thing I would note is that I think the grid is really still trying to figure this out. And a lot of the market operators, the market administrators that manage the grid, you see with like renewables, right, that the markets have sort of adjusted for renewables. The rules are pretty clear at this point. The way that the markets are structured price the products that a renewable project or really any generator can, they price them pretty effectively. So you have kind of a level playing field. You have a playing field that I'll say that that those products are priced and traded in the market very clearly. I think with these data centers, they're still trying to figure that out, right? Like the rules aren't totally clear yet. Every market's looking at it a little bit differently. And so I think it's really very much evolving, but it's going to be like the big story, I think, for the next year. How do these markets sort of efficiently allow this load to interconnect, and pay their fair share or not? How do those costs get allocated with the new load? So I'd welcome Thad and Jon's thoughts as well. If you have anything.
I'm going to have fun with this for a minute because I think there's some facts out there that people. So first off, there's a difference between cloud computing and AI learning data centers. Between the concentration of the owners, the growth rates, they're very different. Most of what is taking the lion's share of debate is AI learning, and there are 4 hyperscalers, maybe 6 if you want to include Oracle and OpenAI, but the big 4. New AI learning data center demand will be material, and it's a big story, but there's a lot of people that are worried and out there and pulling their hair out. I actually heard somebody who's responsible for reliability in this country use the term 5-alarm fire, and I think it's overstated. So here's the math that I think is kind of fun. If you look at NVIDIA, they have, if you take the balance of this year, the next 3 years, they have something like it's a big number, like a $500 billion backlog for those chips. These are the Blackwell chips, the new AI chips. If you take every chip that NVIDIA is going to deliver the next 4 years, call it 3.5, 4 years, total sum all that up, that's 30,000 megawatts of demand growth. That's it. That's 3% growth in the US by itself. And it's a big number. There's 30,000 megawatts of growth. Here in Texas right now, in the official load forecast, which is done because of the way the legislature requires it to be done, I'm not picking at ERCOT here, they've got 60,000 megawatts of growth. So it assumes 200% of every NVIDIA Blackwell chip made in the world is going to get deployed in Texas. Obviously, that's wrong. Why is this happening? Because there are 4 guys that are going to deploy the capital, and there are these large data center developers that are, you can think of names like CyrusOne, Digital Realty, et cetera. They're out there trying to develop. They're smaller developers. Then you have everybody that I know that's got a piece of land that's by transmission line is now all of a sudden become a data center developer. And they're parts of ERCOT. If you talk to a utility CEO in ERCOT, one of them will tell you, one of the large utilities here will tell you, it's 7-1 for what they think is real versus who's applied for an interconnect. So this thing has become super heated, and where the demand is the 30,000 megawatts. Now that's going to happen, and that's going to get deployed, and that's big growth, and they are time, everything that Caroline said. There's time to market. There's who bears the interconnect costs. We've got to get all that worked up, and we'll see what comes next. But this is a number that is manageable in the context. It is more load growth, and combined with the other issues like reshoring, electrification, and other trends that matters. But we should not panic. It is an opportunity, but there's far less opportunity than there are people chasing it right now. The second fun fact, and I'll be real quick on this, is where this goes. And I think we also have to keep this in mind. I mentioned the 30,000 megawatts. GPT 4.0 took months to train. A 400 megawatt data center with Blackwell chips could actually train GPT 4.0 in 19 hours. So I think all of us have to think about the amount of computing power that is coming at us, even with just these 30,000 megawatts. And most of those will get deployed in the US, by the way. But I think we have to understand that either, man, is all that computing power going to run all the time? And if it does, our lives are going to change in ways we can't even do it right now. Or is there, a lot of computing power that's getting put out there and we don't quite know what it's going to do yet? And that's another interesting dynamic, which I think, we won't know for 3 or 4 years. But anyway, I'll stop there. It's fascinating space right now. But I do think that, we need to constrain it based on, kind of a bottom-up build versus taking into account all that.
Totally. Thank you for that, Thad. Jon, did you have anything you wanted to add there?
No, well, I'll add, because I think because Thad and I have talked about this in the past, or it's been the topic of a couple debates. I agree exactly with what Thad is saying. I think the demand is probably overstated. By how much, I don't really know. But I would actually make the argument that even if it is overstated, I think having the trajectory or the slope of the curve flatten a little bit is probably healthier for our business over the long term. In other words, like the run up in stocks and the focus on this from a CapEx perspective and financing market perspective has been I don't want to say overdone, but it has been very, very aggressive. And I would argue having people think through this demand dynamic that Thad just went through is actually healthy for our market longer term. I think it extends the runway and the slope of the curve, as opposed to having the slope at 2x, have it at 1x, but have it go 10 years as opposed to 5 years. So I'm long-term bullish on that.
Awesome. Great. Thad, I want to dig into natural gas a little bit more because I think our perspective around natural gas has shifted a lot in the past few years. We've seen it framed as a bridge fuel previously. How do you see its role evolving in the next decade, especially with growing pressure to decarbonize?
Yeah, well, I mean, and I think this has been well covered already by this panel.
Yeah.
Is, we're going to have more solar, more wind, much more solar than wind, but we'll have more of both. Batteries, as Caroline pointed out, will get deployed further. They play a wonderful role in grabbing when there's too much solar for in the afternoon, moving it to the evening. But there are things they don't solve, like winter storms. And we're going to see new natural gas generation, not just preservation of the ones here, but we're going to have new gas. And so it's going to get deployed. Look, there are ways to decarbonize gas. We're working very hard on a couple of carbon capture and sequestration projects. Assuming that that parts of the IRA, which I believe will stay intact, even with this Congress and this president around carbon credits and the like, I'm hopeful that will become an economic outcome. But natural gas is here to stay, at least for a duration. But I do, and I can't overemphasize this enough. I mentioned that Duke study a little while ago. We've got to figure out demand response, because it is obviously wasteful to deploy huge amounts of capital for relatively few hours a year, particularly when capital around backup generation is already deployed out there. And so some combination of demand response and behind the meter resources that you already have, and there's a great example here in Texas with the grocery store chain that put in a bunch of gas-fired backup gen, so if there's a hurricane, they don't lose all of their groceries. Now they're deploying that economically. And those are stories which I think have to be an important part of the mix too. So but it's here to stay.
We've touched a little bit on the volatility over the past few weeks. How are tariffs and supply chain constraints impacting the pace and the cost of the energy transition, especially around renewables and storage?
I'm happy to start, at least from my vantage point, and then obviously, Jon, I'm sure you have thoughts on this too. I think, at least from the vantage point of a renewable energy kind of developer, owner, operator, it's still a little bit TBD, right? I think obviously there's been a lot of evolution even within the last couple of weeks, and from at least our vantage point, a lot of the panels, like for example, solar panels. Because of the investment tax credit and sort of the domestic adder that you had, that was created in the last administration with the investment tax credit, you got an incremental adder for domestic content. There has been sort of more of a move to domesticate a lot of kind of the manufacturing and some of the supply chain associated with renewables. I do think like a lot of the panels, while they've maybe moved away from China, there's still a lot of them come from Southeast Asia. So, Malaysia, Vietnam, there's still a lot of manufacturing there. I think batteries generally are pretty exposed to China, at least the manufacturers that we talk to. And so I think most probably IPPs developers are still probably running through the analysis. There's a lot, right, of probably projects that are under construction or about to start construction that have contracts already signed. Certainly some that are sort of hustling to try to figure out future procurement, and I think it's still a little bit TBD. I mean, I think we've seen this, right, in the past, right, even in the last administration with the kind of anti-dumping related tariffs. And so I think it's not something that's sort of new, at least on the renewable side to the industry. I mean, there's always been this has happened before, maybe not to this extent, but I think, at least from my vantage point, it is going to have an impact. Is it like a long-term impact? I don't think so. I think it's more of a short-term correction, and people are sort of processing it. At least that's where we are. I'm curious to hear that and Jon's thoughts as well.
Yeah, I guess what I would say is there's it's hard to overstate the interest in the space broadly from a capital standpoint. And so the capital's there to grow the business and develop the growth that we're talking about. What makes this really hard is we're making long-term investment decisions over a short period of time where there's extreme volatility. And I think we can adjust to a higher tariff regime. We can debate whether it's good for the economy or the global dynamics, but even if tariffs go into place, I think the industry can adjust. We just need to take some of the volatility out and have a little bit more certainty or have a game plan. Because if we know what the tariffs are and we know what panels cost or what turbines cost or what some of the batteries cost, that can be reflected in restructuring PPAs and offtake arrangements and investment decisions can be made. So who knows where the tariffs come out, but I would argue the most important aspect for us to think about in having this business and this industry grow is having some long-term visibility and eliminating some of the volatility. Even if they go up, we can manage through that.
Yeah, well, it is impossible to deploy capital right now. We need to get a common set of rules, and there's stuff moving all over the place. I know that will settle down. We just need to get a set of rules, and then we can, make deployment of capital. I would say these kind of environments, it's much harder for developers. It's definitely value accretive for owners of existing assets because it's so much harder to develop and it's so much more expensive.
Thank you, everyone. Okay, I want to touch a little bit on equity and climate justice as we think through the energy transition. How do we ensure that this energy transition is fair? Who risks being left behind, and how should the industry respond to that?
Caroline, I think you should go first.
Well, yeah, I mean, I think what comes to mind for me, right, is we've talked a lot about new load rapidly coming online, and it's, I think, one of the biggest kind of questions up for debate is who bears the cost of some of that demand for power, demand for actually utilizing the grid. Is that actually, or is the new load, the demand, the data centers, are they bearing that? How are they bearing those costs, right, for new transmission? For all of sort of the grid reliability, the balancing that happens to make our electricity work in this country, right? There's a lot of cost that goes into that maybe isn't adequately socialized under the current regime for new kind of data centers coming online. And so that's still, I know we talked about that being TBD, but it needs to be a cost sort of properly allocated across, whether that's rate pay. I don't know what the answer is necessarily, but whether that's allocated across ratepayers, whether that's allocated to the owners of the load. I mean, how that gets allocated, I think, is really important, and is still sort of being actively worked through. So that would be one thing that comes to mind, at least on my end, and sort of as kind of topicals, and given we've been talking about data centers. Renewables cause a lot of volatility in the power markets too. And, the intermittency of generation, we've talked a little bit about, gas, the need for gas, which I completely agree with what Thad said. Like that need for gas generation is never going to disappear, I don't think, at least in the near term. And then are we kind of overly building out to correct for intermittency of renewables? I think, transmission is important. I think demand response is important. We need to be doing grid build out smarter to make sure we don't have costs that are unnecessary that are being allocated to ratepayers. But we sort of hit kind of a lot of those topics already. I mean, Thad, Jon, any thoughts?
So I mean, there's economics. There's also environmental, and there's a question about where plants have been sited, where future plants are going to be sited, and all of that's true. I mean, I think we can start with, there's obviously politics are flowing around climate change right now, but I think most people, what is noticed is that SO2, NOx, and mercury, which are criteria pollutants that come from coal plants, cause acid rain, birth defects, and ozone problems, and so this needs to be kept top in mind. Some coal plants will continue to operate, but we also have to recognize this. A natural gas plant has very little NOx and no mercury and no SO2. Renewables are even better, but we've talked about the intermittency, and so I believe that schemes that work on the criteria pollutants that have actually been cap and trade market-based instruments providing wonderful results over time. Those are less specific to specific communities, but not all of these have a shed just in the community, but broader. And I think that should continue. I do think, though, to raise a question about how hard and how difficult, like there's legislation in Illinois that are shutting down, that requires the shutdown of power plants by 2030 if they're within, I can't remember if it's 5 miles or 10 miles of a community, and I'll get these terms wrong, so be kind to anybody who knows it specifically. But in any kind of EJ community, if you're within 5 or 10 miles, the plant has to be shut down fossil by 2030. Even if it's an updated gas plant with full control, it's got to be gone. Okay, happened is therefore a reliability problem in Northern Illinois. Northern Illinois is part of PJM, the big grid from the Mid-Atlantic to the Midwest. Okay, therefore PJM, to keep reliability in Northern Illinois, has to be building power lines. They kind of skip Indiana from Ohio to Northern Illinois. The way the tariffs work right now, the people in Ohio are going to have to bear half the price. So people are going crazy in Ohio that because of somebody's EJ rule in Illinois, their people are going to pay more. And this gets into an example, a tangible example of some things Caroline are talking about. And these are some really hard problems that take a long time to think through. There's another example. Pennsylvania and Ohio aren't interested in New Jersey and Delaware's environmental agenda, but the only way to achieve it is to build power lines all across their states to the Midwest, which are sun and wind rich. Not only are they worried about who might get the tariffs there, they hate that you've got thousands of linear miles of viewshed having new transmission permitted to fulfill somebody's objective that Ohio or Illinois or Pennsylvania wouldn't care about. So these are very intractable issues here, and I don't think there's an easy answer.
Awesome. I think it's very complicated. There is no easy answer, and it's great to hear how far the impacts of this can really stretch and how we have to think through it. Jon, did you have anything you wanted to add there? Okay.
No, I think that you nailed it. It's so complicated. This is I don't want to call it a black mark on the industry, but it is one of the biggest issues that I don't know how to solve. I don't know that anybody has a great answer in solving it on a universal basis. So we're just going to have to continue to work through it.
But for those of us in the industry, the number one thing we have a moral obligation to do is to engage in the communities where we site our assets, where we work, understand the communities, and spend a lot of time and be very good neighbors. And there's no doubt that over the last decade, companies like ours, operating companies, we've continually tried to raise our game, making sure we're where people want us to and that we engage in appropriate ways with all different types of people in the communities.
Yeah. Before we open it up to questions from the audience, one closing question. I know we've touched on demand response and transmission a lot. If you could unlock one innovation, investment trend, or policy change tomorrow to accelerate the energy transition, what would that be?
Mine is.
Sorry, go ahead. Go ahead.
Well, I was going to cheat and say transmission again. Honestly, I mean that really, both from a permitting construction standpoint, but then even just the study process for connecting new generators. To give you an example, we had a project we started studying in 2019. We started the study process. We got our costs allocated yesterday, right? And with an asterisk that they still may not be final. So going on 6 years later, the project's now operating, it's been financed, right? To have that type of uncertainty around your cost profile, it makes it's just a very difficult thing to navigate, to finance. And so that would be my dream, I guess, is more efficient transmission and study processes on the interconnection side.
Yeah, I would say it's a policy issue as well, and it's focused on transmission. I don't know that we can solve all of the individual ISO regulatory issues or whatever, but transmission would go a long way to do it. And I would be as controversial to say, having eminent domain might go a long way to helping solve some of these transmission issues. I know that's very controversial as well, because no one wants to have a transmission line running through their backyard, but there are things you can do. You can put them below ground. I know that's very expensive, but eminent domain and getting some of the transmission built could be. I know it's not technology, but it is a policy impact that could have a big impact on facilitating growth.
Yeah, look, I think, and I'll answer this in the context that the country ultimately cares about reduction of greenhouse gases, and that is put a price on it. We have a nutty world in which, you've got different policymakers doing different things and a lot of populism going on. And if in fact we're going to go there, and I think in the long run we will go there, the right answer is price the externality and let smart people compete. And you'll get the right mix of assets over time. And that is, as much science fiction as at this point is probably, cold fusion, but that will lead to more efficient outcomes over the long run.
Awesome. Thank you, everyone. Heather, I'll pass it back over to you so we can get some questions from the audience.
Absolutely. This is so fascinating. Thank you, everyone. And Emily, great job with all of the terrific questions. We have them pouring in from the audience. So thank you. And we'd like Emily to be able to be a part of this because she has some great answers as well for some of these. So there's been a lot of great discussion around current volatility. What are a few things related to energy transition that are likely to remain constant in the long term, if any?
Well, look, I'll say I believe that the tax credits that are out there for renewables, which underpin fundamentally the economics of solar and wind, are unlikely to change regardless of the administration. At least in the near term, the fact of the matter is a lot of these investments are occurring in red states, and although different people will talk about things in different ways, I think it's really hard for Congress to remove those. And so I would say probably in this nutty world we're in, something that you can probably depend upon would be the tax credits for wind and solar and storage continuing. There's one item.
Yeah, I agree with that. I think from my vantage point, you look at power markets and how they price different. I mean, obviously you have a market for electricity, but you have a market for the green attributes of project. You have a market for reliability, right? And in most markets, not Texas, but in other markets, you have a market that prices reliability. I think now how the relative prices and how those get kind of allocated, for each project, I think could shift. But I think that those fundamental, like the value and the market for pricing those attributes of a generation project, I think will remain, even despite regulatory uncertainty in some way. There will always be a market, hopefully, that prices the value of a reliable, asset that can be dispatched on demand when the power is needed. And now there's a market, right, for the greenness of power as well. Like I see those sort of having staying power, at least in the foreseeable future.
I would just add by saying I think technology improvements, and they may not be breakthrough technology, but just incremental improvements on things like efficiency of wind turbines and blades and solar panels and batteries is going to have a big impact in driving down the unit level economics of electrons. We've seen tremendous improvement over the past 10 years, and I don't see in all those metrics, and I don't see that changing. I think we're going to see continuous improvement in efficiency from that perspective. And again, not a breakthrough technology, but important in terms of how we deliver electrons to consumers.
Great, and thank you. Any insights into this energy transition outside of the U.S.? Any hope, any bright spots, any observations?
Yeah, it's a good question. I think it still remains to be seen, particularly given some of the tariffs dynamics and some of the geopolitical issues, particularly in Europe. But I think it's really hard to predict. I think the different business models in Europe and in China for how people think about getting not only gas and electrons to consumers, but I think that's driven as much by geopolitical dynamics as it is sort of industry dynamics. And so it's anybody's bet on what happens like in Ukraine and China. And so people can develop views based on some of those geopolitical dynamics. It's very uncertain.
The political landscape makes everything a little bit more unique. There were some comments about sort of, do we just wait until 2028 in order to make changes? Are there things that, given the uncertainty in the political landscape, that we can be doing it now in the uncertainty over the next few years?
Man, I hope we don't have to wait for 2028. I'm hoping, whatever the tariff circumstances becomes clear, we understand who FERC commissioners are going to be and where they are and kind of, how the interactions occurred. There are a lot of these things that I think will become clear well in advance of 2028. And I think that lets people get back to business. I do think, and look, I think there's some Supreme Court decisions which could come down which will impact this too, because one of the things that's really difficult is if every administration you end up with huge flip-flops, it's very hard to deploy capital as well. So I think there's some new case law in the current court around how much breadth any given administrative branch, the executive branch has versus Congress. And so that's going to matter. And we're going to get some decisions on that coming soon. But at least I'm optimistic that things are going to settle down and, we'll all be able to, get working hard on deploying some new capital here soon.
Yeah, I guess what I would add, I agree with that. I think, look, a lot's been made in the media of the disagreements between the administrations and the Republicans and Democrats on things like the IRA. At least in our discussions, the bid-ask spread on what is in the IRA is not that broad. We're pretty sanguine on what happens from a policy perspective. And to go back to a point that Thad made, I mean, we don't see much changing on the Inflation Reduction Act, even with this new administration, other than perhaps around hydrogen and perhaps around EVs. And the reason is because the IRA has actually been pretty good for promoting the industry and jobs and taxes and things like that. And so while the media makes it a big deal, it's going to largely stay intact, at least from our perspective. So that's good for our industry. So hopefully that won't change in 2028.
Yeah, I agree with that. And just to add one other point, you know, in the past where we've had volatility around tax credits in the past, or sort of a little bit of start, and you know, in a previous sort of administration, there was uncertainty, and a lot of the demand for renewables, for power purchase agreements, procurement came from corporations that stepped in. As utilities were doing less procurement, these corporations, the Googles, the Targets, the Home Depots of the world, right? They stepped in and were buying power from these projects at a price that made the economics work. The financing followed, the projects came online. And I think, to me, I'm optimistic, right? Having lived through that time, right? You see the AI demand. There is demand for this still, not government-driven demand. It's a lot of these power buyers. And if they can buy at a price that makes the economics work, I think you'll still see these projects continue to come online like normal. And yeah, I'm optimistic just having seen that demand come from other places.
Okay, last two questions. What about renewable gas? Will there be a robust market for RNG, or will it be a small niche?
It's expensive. I think it's small.
Same. Unit level economics make it really, really hard.
And our last question as we wrap up, being that I work in career services, I love questions around career in this sector. So practical career question for you. So where should new or recent Tuckies go, or even not new or recent? What large companies on the industry side are the industry respected rock stars of career development, are culturally aligned with Tuck values, and are very likely to survive and thrive in the next 5 years of market and regulatory volatility? So everyone take your magic, the magic 8-ball out, and let us know what you think.
Wait. None of the investment banks? Come on.
Morgan Stanley, 100%.
But not Swift Current.
There you go. Yes, love it.
No, I'm kidding. I will make a plug for working for an IPP developer. You see a lot, there's a lot of varied roles that you can play with an MBA, spanning asset management, finance, revenue structuring. I mean, there's a lot of different roles that you can play, and it's not boring. It's constantly changing. The markets, the macro environment's constantly changing, and so it's sort of a fun seat to sit in. But yeah, that would be. I don't have specific names.
I'd put the same plug in. I think that's a great opportunity.
Yeah, well, I would say what's so fun about this sector is that we're at the perfect mix of pure microeconomics, which hopefully gets a lot of Tuckies excited, heavy public policy and big capital, and you kind of have to stir it, and it's a complicated way, but to make decisions, and there creates a lot of opportunity. And I will be biased here. To agree with Caroline, I actually think the competitive power sector, which includes developers like Caroline, it includes IPPs, it includes people like us that also have retail and the like, is a really robust sector. Nothing wrong with the vertically integrated utilities. They have to solve all of those too. But the commercial and the scrappiness and the development and the project finance and learning how all that works together to provide growth and value, I think the competitive power sector, broad writ, is a really interesting place to go.
This is great. I can't thank you all enough. I'm sorry to everyone whose questions we did not answer. We had a ton come in, but this was so thorough and really wonderful insights. So I just want to thank our panelists and our wonderful moderator for joining us today. I truly felt like this could go on for hours because it's so interesting. So Thank you for being here. I also want to just remind our audience members that this will have been recorded, so please find that on My Tuck. And also join us tomorrow from 4 to 5 to continue the conversation with fellow Tuckies, because all of this is so interesting. And as a reminder, every month we do a Tuck Alumni Lifelong Learning virtual programs. And next month, for any of you who are on the job market, we are going to be doing how to stay resilient during a very difficult and challenging white collar recession that we are experiencing. So make sure you come to that as well. You also will be getting a survey, so we would love to get your feedback. So again, thank you so much to this wonderful partnership between alumni engagement as well as the Rever Center. Jonathan, thank you so much. And I can't say enough, Jon, Caroline, Thad, and Emily, thank you for being a part of this amazing panel. And we look forward to seeing everyone at future events. Thank you, everyone.
Thanks for having us.
Thank you.